we're recording. Okay, so we were discussing these points about relating to inflation, and then we got into the discussion of, quantitative easing. I don't remember exactly how that happened, but anyway, it doesn't matter. It's an important discussion anyway. You need to know about quantitative easing, and it probably won't be covered because this is not the kind of topic that generally gets covered in the traditional MBA courses. So this, it's better to cover this. It's a very important topic, and so different measures of inflation is what I'm just going back a little bit in what we covered because I want to just fit in one more point that you have different measures of inflation and all this, and then what I'm mentioning here against tips is also. So remember, the tips actually works on the basis of CPI. So the only point I want to make is that you have to be careful that when you're doing any kind of hedge against inflation, that you have to see, like for instance, as you can see in the case of tips is working on the basis of CPI. Now, as I said, there are different measures of inflation, and so what you have to really see is what is it that you actually want to protect against. Okay, so what I'm mentioning here is, I think you'll get the thread, that just to be very, very meticulous about and very thoughtful about what you're trying to do. Don't just say that, okay, this is a hedge against inflation. What kind of inflation are you trying to, even tips protects only against rises in the CPI, because as you can see in the definition of tips, it is tracking the consumer price index. Now, there are actually other measures of inflation, and very often you see there are problems with data collection as well. All macroeconomic data actually is, you have to really consider it, although we release all the GDP figures and all these things. As you know, there are lots of controversies about how you're measuring GDP. A few years back, the government changed, in India, the government changed the method of measuring GDP and all the price deflators and all these things, which you might have covered in your macroeconomics. So this area itself is not a perfect science. There are lots of disagreements. Again, this is not like physics. In physics, there's not much room for disagreement because you can just do an experiment and see who's right. So you can't do that in economics. So there are lots of issues here with the data itself. And second, then you have to see what are the components of CPI. And as I said, there are different measures of inflation. Okay, so even tips will protect you. As I said, this is the best hedge. You'll see later on that Graham also is talking about tips as a good hedge. Okay, so but tips is the most targeted hedge against inflation. But the point to understand is that even tips is only protecting you against a specific measure of inflation. So, but there are different measures. So tips protects only against rises in the CPI. Okay, so then you say, but there are different measures of inflation. There are different measures of inflation. So it is possible, you can't rule out these, as I said, because there are data measurement problems, and there are components also which are different in the CPI and the WPI. Especially in a country like India, you can jolly well have a divergence between CPI and WPI. Okay, although in this case, it will be in the nature of, probably will be in the nature of CPI being higher than or persistently higher than the WPI because of the problems in our supply chain. We have too many middlemen in the supply chain. So, but in that case, CPI will be higher and you will get compensation through your tips. But in any case, I mean, the very fact that there are different measures of inflation and they have different components. So it's quite possible that you might have a, one of these measures of inflation may diverge from each other, right? So therefore, yeah, this is what I've already mentioned earlier. Okay? So you can have divergences between different measures of inflation. So basically, you have to see, so need to be clear about what specific type of inflation you want to guard against. Okay, so inflation which you wish to protect against. This is what you have to be clear about, and then you have to look at the components of the CPI. Okay, now if I remember right, in the US, the rental agreements actually house rent is a part of the CPI component. Okay, you have to look at the components. So therefore, you have to see. So you need to be clear about what specific type of inflation you wish to protect against, and um, accordingly investigate the components and the weights also. So if you really want to talk about inflation protection, it's not so simple. Okay, you have to look at investigate the components and weights of the different types of prices included, the different components and weights of the different type of prices comprising the different measures of inflation. Measures are indices of inflation. So basically, when you have to protect against some kind of risk, the different comprising the different measures or indices of inflation. This is what you have to do. You have to look at the component. And so, for instance, if you're protecting against rents and you're using an inflation hedge, which is actually protect against WPI, the WPI will not have house rents as part of the components. So therefore, you think you're protecting against inflation because WPI is one of the measures of inflation. But actually, your analysis is not sufficiently in-depth and it's not sufficiently focused on what you're trying to achieve. So these kinds of pitfalls you have to be careful about. And all these measures of inflation will miss out on, and generally what we will say is that this is where we went into the discussion of the monetarist theory. So why did I get into the discussion of the monetarist theory? Because the theory is not correctly formulated. It does not consider asset price inflation. It doesn't consider asset prices. It treats goods as separate from asset prices. The point I'm trying to mention here is that you have different measures. You have to see exactly what you're protecting against. And almost all measures, okay, I'm pretty sure it's all measures, but maybe there's a new measure somewhere which I'm not aware of. But almost all measures of inflation, all traditional measures, all traditional measures of inflation. This is CPI, WPI, PPI. These are all traditional measures of inflation. Okay, and this I can write without almost all traditional measures of inflation, which ignore inflation in asset prices. Okay, so in the case of asset prices, there are all kinds of assets. Okay, asset prices. So inflation in asset prices, and most of them would include, because what the CPI includes is house rent, but it does not include and many of them include the sort of many exclude prices of real estate rather than rentals. Okay, prices of real estate. So sometimes you can have a discrepancy between prices also for some periods of time between the real estate prices and real estate rentals. So if you're trying to protect against increases in the prices of real estate from the perspective of a future buyer, that's different. That's a different perspective than protecting against increases in rentals as someone who will always be renting. Like you might have noticed, a lot of these. You guys are the younger generation, so I don't know what this. They keep having these the categories in marketing, all this Gen Z and Gen X and all these things. So these guys, the very young generation, is actually said to be not much in favor of owning houses, at least in the West. So they're mostly types, rental, more focused on rental. So if that's your general strategy anyway, that's a different focus from, again, you have to treat it as a different thing. You should not assume that real estate prices for purchases and real estate rentals will necessarily always move in the same, in lockstep with each other. There could be significant divergences, so you have to treat them as separate variables. And there's, of course, the locational aspects to real estate always, right? So all these, so what I'm trying to mention is all traditional measures of inflation ignore inflation in asset prices. So all these things are very important. So this is also important that, when you're talking about protection against inflation, you have to be very particular about what is it that you're actually protecting against in terms of rises in what kind of asset or service. So that you have to be clear about. and you have to examine the measures of inflation. So in this case, if you're going to use TIPS as a protection against inflation, you have to look at and then you see that TIPS is protecting. TIPS is indexing to the CPI. Then you have to go and look at the CPI and look at the components of the CPI and see whether it's actually going to do the job for you based on what you specifically want. So this is just a point I wanted to make, that you have to be very specific. You can't just think of, okay, inflation protection. So there are many nuances when it comes to inflation. So there's, I think, something else which I want to mention. Okay, PP. You should also look out this, check out this measure called PCE. Okay, PCE is actually the personal consumption expenditures, which are a big target of this. PCE is important because you only get this in the US. The PCE is actually, I'll mention this, the rest you guys know. Okay. Personal consumption expenditure. Why is this very important? This is important because the US Fed is, this is the main focus for the US Fed when they look at whether there's inflationary pressure in the economy. This is the index of inflation that they consider. Okay, so this is what they actually, in fact, look at core PCE. But you know that for every measure of inflation, you will have a headline figure and a core figure. So, sorry. So again, remember the CPI is different from personal consumption expenditure. You have to see what this is focused on expenditure, and this is generally just focused on price levels. The price levels could be going up. Maybe people are just making do with less and living on a subsistence level, and they're not actually spending much. So these are two different measures, although they are very much focused on the retail consumer. So this is the point I wanted to make here. So that brings us to the so because there are different measures of inflation, and all of these measures include traditional measures ignore inflation and asset prices. So what you have seen, and inflation, and that's why I discussed the monetarist theory of inflation, because the monetarist theory of inflation is, according to me, not properly formulated. They should have treated goods as also as part of a more general category of assets. And they should have also considered stocks and bonds, currencies, commodities. All of these things should have been considered as assets, and that would have actually made the theory more correct, because what you saw in the in this part that I'm talking about here, okay, that we had very high inflation and asset prices, but after the 2008 financial crisis, you can see this as I showed you this chart of the chart of the S&P 500. So we had very high inflation and asset prices, but inflation in goods markets did not show up, okay, until very, very recently. So this is why I mentioned this, that when you're talking about inflation, you focus what kind of inflation are you focusing on. These guys also, like some of the measures of inflation, these guys also made the mistake of formulating their theory with a narrow focus on goods markets instead of a broader focus on asset markets, and treating goods as a class of asset, as a species of asset. So if you have a broader theory just focused on assets, that would have been appropriate, because that would have covered then you would have said that, okay, my theory is not wrong, because certain asset prices are going up and goods are going to be just treated as another type of asset. So you say, okay, certain asset prices, like the prices of commodities and goods, are not going up, but other asset prices like stocks and bonds are going up. So that would have basically ensured that the theory would have been that the theory would be valid, right? So would have been valid. So anyway, so this is just a point about the monetarist theory, which we're wrapping up and just recapping. All right. Now this quantitative easing part of it, which we wanted to discuss. Okay. So as I said here, so we discussed quantitative easing the last class, and then we also discussed why they're not touched. Okay. The answer is basically that the policy rate is near zero, which we saw here. Okay. So we can just open this up once again, right? And so that Soumya asked a very good question towards the end of the class, which is that why would they choose one or the other? And then the answer is that you look at the impact, and the impact is actually quite different, because in the short-term policy rate, when you focus on the policy rate, the impact is much more limited. It's just a kind of a money market, wholesale market kind of focus. Whereas in the case of when you do long-term purchases of long-term bonds, the impact on the long end of the yield curve, that's a much more difficult impact to measure, and it's much more broad-based across the economy. So that's a more dangerous game to play, and that's why probably that these guys prefer to use the policy rate until it goes to a point where the policy rate is so low that there is no point in doing cutting interest rates anymore. So therefore, you try to, and the economy is still kind of stagnant. So you basically try to stimulate the economy by flooding the system with money through quantitative easing, right? So now, so if you remember, Soumya answered this question: what is quantitative easing? Okay, here we say, where was the point I noted down this question? That yeah, so central banks pump money into the system. So I was asking her a counter question. Okay, so yeah, this is the, so we'll start today here. Okay. So the question where we start today now with uh, with fresh content is this. So this quantitative easing, which Soumya said, is central banks pump money into the economy by buying bonds. And my counter question was, are they buying bonds outright, or are they buying bonds as part of repos? Okay, so let's understand basically. So first, let's understand what is a repo. Okay, a repo transaction. So if you see here, so basically what we can understand is, uh, first you heard of repos and reverse repos, right? You heard of repos and reverse repos. So first thing we have to understand. Okay, so first let's try to understand repos, and then we'll talk about outright bond transactions. Okay, outright. What is the distinction between outright and repos? Okay, so what are, first let's understand what are repos. Okay, so repos, if you see here, I'll put a link to this. Okay, here you can read on this a little bit more. This is a very good website, so you can actually just gobble up everything on this website. You'll learn a lot about monetary policy, and this is all very good information. There's a lot of garbage on the internet, but obviously these kinds of websites, you will learn a lot, and all the information will be accurate, the high quality information. So let's keep this here. All right. Okay. So first, what are repos? Let's try to understand them. So let's understand a few terms. We have repo and reverse repo. First, you have to understand that repo and reverse repo. You kind of would have heard these terms in our RBI policy meetings as well. RBI leaves the repo rate unchanged. These kinds of discussions you would have had, right? You would have heard these discussions on TV, hopefully, if you're following the monetary policy debates and the discussions. Okay, so repo and reverse repo refer to the same transaction. That's the first point you have to understand. So if I'm selling shares of Facebook to Rohit, when I talk about the transaction, I'll say I sold, and when Rohit talks about the transaction, he will say I bought. But it's actually one transaction. It's the same transaction. Okay, two different people refer to it in different ways because of their the difference in their perspectives. Okay, the first thing, in a similar way, just like a sale and purchase actually are referring to the same transaction. Similarly, repo and reverse repo refer to the same transaction. Okay? And actually, I don't want to use the term borrower, because I've not yet said that repos are a form of secured lending. Let me just mention this. Okay, let me mention this first here. Then otherwise I can't bring in the borrower. Okay, repos are, this S should be small s. Repos are a form of secured lending. Okay, so when you have secured lending, so what is a home loan? What kind of lending is home loan? Is it a secured? Is it, in most countries, the home loans are secured lending or unsecured lending? Anybody?
Secure.
Yeah, secured lending. Okay, yeah, secured lending. And so when you have secured lending, what is the first, and what is the security, or what is the term that we use is collateral. Okay, in a home loan, what is the collateral?
Mortgage.
Yeah, the mortgage is not the collateral. The collateral is the house itself. The mortgage is actually the way you secure the way you ensure that the mortgage is a legal document through which you ensure that the lender has access to the collateral in case of a default. Okay, so you have to be very careful about how you use the words, right? So it is actually the house that you buy that is the collateral. Okay, the collateral is another term for security. Okay, repos are a form of secured lending, and housing loan, just as a discussion. What you have to remember is, so for we can write this down and be clear about these terms. Okay, example, in a housing loan, need to be make sure that although we are covering some basic stuff, but we want to make sure that everybody's got everything correct. All the basics are correct, and you know exactly how to use the words. In a housing loan, okay, uh, another form of secured lending. Another form of secured lending. The security. What happens? Somebody wants to enter. Oh, okay. Yeah, Piyush has a Pant has raised a hand. What is your question, Pant? Yeah, I saw that Pant had raised his hand. Was it just accidental? Okay, so we'll treat it as accidental since uh, there's no question. Okay, so let's go back to this. So in a housing loan, another form of secured lending, the security stroke collateral. So another term that you learn in case you did not know it, collateral is a term we use in finance. So collateral is basically the security. The security we refer to as collateral. The security of collateral is the house uh, that is bought, okay, with the loan. Okay, it's the house that is bought with the loan. The mortgage is, just to give you a clear idea, the mortgage is a legal instrument which ensures that ensures that the lender has the right to seize the collateral in the case of a default. In case of a default, okay. So now you know how to use the terms. So the security is actually the house, and the mortgage is a legal instrument which ensures that this lender has the right to seize the collateral. Okay. So this is just our example actually. So we'll put this in. Right? Okay. So repos are a form of secured lending. Okay. Now the security. The collateral, what we use is we use debt securities as collateral. So it's a different kind. So there is a similarity between. So if somebody asks you what is the similarity between what is similar to mortgages and a housing loan backed by a mortgage and a repo, then what you can say is that, well, they are both forms of secured lending. And what is different? And in one case, the asset or the collateral is the house that is bought with the housing loan, and in the other case, in the case of repos, the collateral is different. It is normally debt securities, okay, and it is normally using debt securities. Okay, so normally we use government debt securities, but usually government debt. But these days, central banks are so desperate that they are accepting, even private sector debt. Okay. We have to write this as even private sector debt may be allowed. Okay, so this is actually at the discretion of the lender. So as we said, repos are a form of secured lending. So in any market-driven transaction where you have freedom of contract, so what kind of security is to be accepted, especially when the government is one of the parties typically. I mean, not the government as such, but an arm of the government. What we say in the law, what we call an instrumentality of the state. So the Reserve Bank of India is an instrumentality of the state. The Federal Reserve is an instrumentality of the state, in the sense that what they do are basically in the nature of public policy, and they're carrying out the wishes of the elected head of the executive branch. So that's why they're usually are an instrumentality of the state. So usually government debt, but even private sector debt may be allowed. Okay, so basically this may happen because you have freedom of contract, and one of the parties is usually the now instrumentality of the state. So they will. It is up to the lender as to what kind of collateral is acceptable. So if you, in the extreme case, you can just go from secured to unsecured lending. You can lend money without any collateral. That is also up to the lender. So if the lender is comfortable doing it, then he can do it, right? So generally there isn't a bar on that. All right. So this is how you understood what is secured lending and just the terms collateral and mortgage, etc. Now, so we are now doing, so we've learned that secure repos are from secured lending. And so the moment you have secured lending, the moment you immediately know that there must be some kind of collateral. So the question is, what kind of collateral? The collateral in this case is normally debt securities and usually government debt. All right. Now we come to another term. So now we can refer to now we can use terms like lender and borrower, because we already mentioned that repos are a form of secured lending. So there's a secured lending transaction. There must be both a lender and a borrower. Refer to the same transaction. The borrower, we would call, say the borrower is deficit funds. Okay, instead of writing has a funds deficit, such a so many words, I'm just going to write the borrower as deficit funds. Okay, so it's not strictly speaking grammatically correct English, but borrower deficit funds uh, refers to it. Uh, well, let's just calls it uh, calls it uh, repo, and the lender calls it a reverse repo. So we know, again, like the example I gave you, one person sells something, he calls it a sale. The other guy is buying and he calls it a purchase. But it's the same transaction. So the borrower calls it a repo, and the uh, lender calls it a reverse repo. Okay. So now another thing you need to know about repos is that the correct term for, so I'm not writing repo as repurchase agreement, because you can find it. I've given you the link to this. You can find here on the New York Fed page that repos are actually short for repurchase agreement. But again, this terminology is not really correct, because it could be improved. Let's put it this way. So the correct term for repo would have been, we don't use that in the markets, because that's what it is actually. Uh, Sale and repurchase agreement. Of course, you could say that if you're talking about a repurchase, that means there must have been a sale, but it is better to be more explicit. So sale and repurchase agreement would be a better way of doing it. But this is just my opinion. Uh, that would explain exactly what the transaction is. But in the markets, we just don't go and say that repo stands for sale and repurchase agreement, because in the market, you have to say repo stands for repurchase agreement. This is just for our discussion. This is what I feel would be more accurate than what the actual transaction is. Okay, so the correct term would have been sale and repurchase agreement. And here we can add one more thing, which is every repo has two legs. It's a transaction which has two legs. Okay, the first one we call the near leg, and the near leg and a called far leg. Okay, the transaction has two legs, near leg and a far leg. Okay. Now you can see this transaction a little bit better on the. You can make a website here. I mean, we can just add. something like this is our. So we'll create a box here. Okay. So here let's do the transaction and say FRBNY. FRBNY stands for Federal Reserve Bank of New York. That might be the website also. No, they've called it New York Fed. Okay, so FRBNY is New York Fed. Okay, so they are the lender and they are surplus funds. Okay, so I'm not writing that anymore. Then you have, let's say, you have this side. Let's have Citibank New York. Okay, City New York. Now, City New York is the borrower. So for him, it's a repo, and for this guy, it's a reverse repo. This guy was the lender. This is a reverse repo. All right. Now, what will happen here? Okay. So let's write the near leg first. Maybe we need to make this a little near leg. Increase this width a little bit. Okay. So in the near leg, what will happen is, so here these two guys are, so everything that happens here is going. I mean, if I show an arrow here, so here the near leg, what happens is two things happen. That you have, let's say, $1,000 of US T notes. T note means treasury notes. So in the US treasury market, any maturity from where the original maturity is from 2 years to 10 years, we call them notes. And in the case of anything more than 10 years, we call them bonds. But this is just a kind of a market convention. It's not really conceptually, it's not really conceptual as such. Conceptually, what you should really remember that you have up to 1 year initial maturity. That's the money market. And again, without coupons. And conceptually, what you should remember is the distinction the moment you go beyond 1 year initial maturity. And most of the time with coupons. Very, very rare. Theoretically, you could have a zero coupon issuance, but that would also have initial maturity greater than 1 year. So it would also be a bond market instrument. So the conceptual distinction that you need to remember is money markets versus bond markets. And in just that in the US market, we refer to 2 years to 10 years as they are called notes. So just like when you go into the German government, if you go into the German government bond market also, they will have different types of names like Bobels and Bodens and all these kinds of names, but they're all basically German government bonds and all more than 1 year issuance initial maturity. So all part of the bond market of the German bond market. So here we have T notes. Okay, so $1,000 of US T notes. Now what's happening? This is going to New York Fed, right? And in the near leg, we can have again we'll have a leg, right? And the near leg, what is happening here? Let's say now you need to learn one more thing, which is okay. So let's say we are going to put this in a one second. Put this in a. Let's put this as USD here, and we'll just here and write $1,000 as well. I want to do some formulae, right? And in the near leg, you will have. Let's describe this. Write one more thing here, which is you need to learn a new term called haircut. Okay. Haircut, and then let's write this. Haircut is 2%. Okay, and then we'll write. You understand this is a term that you need to learn, which is haircut, and then the near leg. What we'll have here is. It's better to do it as. So these amounts are in USD. amounts are in USD. So you have, yeah, USD notes. Okay. So $1,000 of USD notes is going to the New York Fed, and this is going to Citibank. $980 is going to Citibank. The positioning could be better. We could put it here, I guess. Next, give them lots of arrows to go to Citibank. It's going to the Citibank side. $1,000 of T notes is coming to the FRB and New York Fed side, okay, and $980 is going to Citibank. So you have to learn a few things, which is in this example you have. We will use this terminology. Okay, so I'll just say refer to sheet. This should be just called one actually. You're just using one sheet. Okay, so we'll just say refer to. Okay, I'll just say refer calc file. Okay, so you know which calc file you have. You have only one calc file. Calc file. Actually, we have only one sheet, so I don't even need to refer to anything. Okay, refer calc file and the sheet and the kind of B33. Okay, B33 is the reference. B33 is the cell reference. That's where we start. Okay. Okay. So if you refer to that, okay, the example that we have given. Okay, so I need to write down some terms. I want to write down the terms here rather than in the spreadsheet. Starting value of collateral. Technical terms which you need to know in a repo transaction. Starting value of collateral is, what is the starting value of collateral? Anybody wants to guess? We have seen the example. What should we write? Is the starting value of collateral? Anybody? No? Okay. Starting value of collateral, because I've already told you that this is what are the things that you already know? That repo is a secured lending transaction. What kind of collateral does it use? Therefore, it must have collateral. What kind of collateral is used? Debt securities, usually government debt securities. So then I showed you an example where, and I said repo and reverse repo there actually should be called a sale and repurchase agreement, and it has two legs, near leg, far leg. Okay. So now starting value of collateral is actually $1,000. Right? This is your starting value of collateral. Okay, we will see what is meant by this. Okay, so let me just explain this. So it's a haircut is equal to, so haircut we have to define. Okay, actually the percentage discount. Okay, let me first explain this. So what will happen here is that that Citibank wants to borrow. Okay, these guys are deficit funds. They want to borrow, which means essentially the money market situation is tight. The market for reserve funds, interest rates are going up. Okay, remember how the whole scheme works. Okay, basically, just at this point, just understand that the market is tight. Money market is tight. There is a tightness in the money market. That's why the New York Fed wants to do repos, and they want to push some funds into the system, and thereby put downward pressure on the policy rate. Okay, this is the background. To understand the background, this is what they focus on: the policy rate, which is now the target range, the effective funds rate. The target range is actually 0 to 0.25%, 0.25%. Now, in this also, there could be a situation where the money market is tight, and the rates are now pushing upwards and pushing above 25 basis points. 0.25% is 25 basis points. Now, maybe the rates last night they saw that the rates have gone to, people are borrowing at 30 basis points, 35 basis points. So it's outside the target range. And this is not acceptable because the FOMC has decided that the Fed funds, effective Fed funds rate, which is the policy rate, the interbank market for reserves, is where the banks are borrowing reserves from each other. Kind of similar to our money market. Of course, there are other transactions that happen in the money market, but one of the major types of transactions in the money market is how banks are borrowing reserves from each other. Sorry. So the way it works is the New York Fed is in charge of uh, in carrying out the, if you can see here, for instance, they say, yeah, authorized by the FOMC. So the way the policy making works, the FOMC is a part of the Federal Reserve. These are the guys who take the decision on. They keep meeting every few months, and just like our Reserve Bank, and they take the decision on where this rate should be. Right now, it's 0 to 0.25%. What should be the target range for effective federal funds, which is basically what should banks approximately pay, because it's a range, so we have to talk about approximately. So what they're deciding essentially is what should banks have to pay, what rate should banks have to pay to take care of their reserve requirements, okay, in the interbank market. So now this, they have now set a rate. The FOMC has set a rate that it should be now 0 to 0.25%. Now these guys, the New York Fed, they have the open market trading desk of the New York Fed. They also do other stuff. The New York Fed is the Federal Reserve Bank of New York, and so they also have a foreign exchange trading desk. So U.S. dollar interventions, this like currency intervention has to be done by the New York Fed, by the U.S. if the U.S. wants to intervene in the currency markets. Quite rare actually. So if they want to, it would be done by the New York Fed. They would have a foreign exchange trading desk as well, which will call up the banks and start trading with them. So these guys also have an open market trading desk. This is much more active because this is like the day-to-day, uh, you know, conduct of monetary policy. So what are these guys supposed to do? They're supposed to ensure that the uh, target range that has been set by the federal FOMC is actually maintained, because this is actually a market rate. So if the money market is tight, then the rates might start moving up above the target range as well, or even at the top of the range. So people are borrowing at 25, 28, 30 basis points. They're watching a lot of transactions happening at 30 basis points, 32 basis points. So it's already outside the range. So that means why are rates so high? Because money is tight. Okay, you understand the basic logic. When in economics, when ceteris paribus, when there is a decline in supply, okay, when supply goes, when there's a supply deficit, prices will go up. Okay, so here this is loanable funds. When the basically the money market interest rate is the price of loanable funds. So when loanable funds decline, that is general liquidity in the market system declines, then interest rates will go up. So that's what is happening. So from the rise in interest rates, you can conclude that there is, you can either say supply is down, or you can say there's excess demand and it's pushing prices above the target range. So this cannot be accepted by the New York Fed, because it's their job to ensure that the effective federal funds is trading within the FOMC's target range of 0 to 25 basis points. So now they have to step in. Now what will they do? They see that rates are high, pushing higher. That means money market is tight. There's not enough liquidity in the market, so they need to push some funds into the system. So now they'll announce that they're doing repos and see how the transaction works. When they say they're doing repos, they're actually talking. They should actually be saying that we are going to do reverse repos, but they actually, the way the language works in the central bank world is, the Fed will say that we are doing repos. Actually, they're talking from Citibank's point of view. So it's like, if they want to let Citibank buy, the Fed will actually be a seller because Citibank will be a buyer. But instead, the way they say it is, okay, I'll let you buy. So that's why they say, if you read the language, it might be confusing when you read the page later on. But when the open market desk says we want to do repos, actually they want to meet. They are talking from Citibank's perspective. They're putting themselves in Citibank's shoes and then talking, right? So basically, they'll announce every bank. So most of these major commercial banks have a money market trading desk, which in the Treasury division, and in the money market trading desk, they will have a hotline to. Many of them will have the big banks will have a hotline to the New York Fed, the open market desk of the New York Fed. So they will just announce over the New York Fed will announce over the hotline that we are going to do system RP. So there's the customer RPs and Repo is called RP for short. Okay, so we should write that as well. RP is actually, you see that maybe in some of the acronyms that they use. RRP. Okay, RRP basically reverse repo. Okay, and so basically RP is, they might have mentioned RP here as well, but RP in the market means repo. In the money market, if somebody says the Fed wants to do RPs, that means the Fed wants to do repos. We should write that also somewhere here. Um, Repos and reverse repos, if I was the thing that. So short forms. Okay, let's write it. This is repo. Right. This also should be aware. You should be aware of. Okay, repo is equal to RP, and reverse repo is equal to RRP. This is the money market language. So, and then they have two types of RPs that they do: system RPs or customer RPs. I think we don't need to get into that. It's basically customer RPs is on behalf of other central banks. So we'll just say they are basically doing system RPs. So what will happen is once they see this, so if you look at the whole story, how it works, the FOMC meets and sets the target range for the effective federal funds, and these guys, they are authorized by the FOMC to conduct these transactions and maintain the rate within the target range. They are observing the rate every day, all the time. They see it going up above the target range, above the ceiling, and that means the money market is very tight. They need to push. They need to push the interest rate back down. How will they do that? They need to put some funds into the system. Excess supply of money will bring prices down. Okay, so et ceteris paribus, excess supply will bring prices down, and that the interest rate, being the price of loanable funds, will come down. So now they want to push some funds into the system. How will they do it? They will do it by doing, so they'll announce over the hotline system 2-day system RPs or 14-day system RPs. That means the difference between the near leg and the far leg will be 2 days or 14 days. So every repo has a term associated with it. Okay, has a period. This also we should write. Uh, yeah, and a far leg and every repo has a uh, tenor, has a tenor or tenor means a period. Okay, tenor or period associated with it, which means just like when you look at, for instance, any fixed deposit, if you're looking at Axis Bank fixed deposits, and you tell me that, oh, the interest rate is 6%. First question I'll ask you is for which period, because interest rates are always connected to periods. In that sense, a repo has a tenor. Every repo has a tenor or period associated with it. Okay. So the Fed will say, let's say 14-day RPs, 14-day system RPs, which means the Fed feels that this tightness is likely to persist for 14 days. So we need to push some money into the system by, we need to pump in some liquidity for a period of 14 days. Actually, most of the repos are done for overnight, but I just want to give you some, to make the example a little easier to understand. I want to give a reasonably long period, because overnight it almost seems like it's very unusual kind of period. So therefore, but you have to remember, most of the time this is because this is overnight Fed funds. Okay, this is actually the rate for overnight Fed funds. So overnight borrowing of reserves between interbank in the interbank market. This is actually for overnight, because remember, every interest rate has a tenor associated with it. Every time you see an interest rate, you should always ask yourself, this is the interest rate for which period? 2 years, 1 month, 9 months, 30 years. So otherwise, you're not clear about what the interest rate is. This is actually overnight federal funds. Now, so these guys want to push money into the system, and they're going to announce 14-day system RPs. Okay. Now, so once they announce that, then the banks know they are talking actually from the point of view of the banks. So which means they are going to let the commercial banks borrow money from the Fed using government bonds as collateral. Right. So now we go back to this. So that's why this is happening. So you see, what will happen in the near leg? Citi will give $1,000 T notes to the New York Fed. The New York Fed will give $980 to Citibank. Okay, and there is another term that you need to know, which is the haircut. So what the New York Fed says is, okay, you guys want to borrow money. Uh, yes, so you give me. I'm only doing secured lending right now, so need to give me a security, and what I want is U.S. government bonds. So okay, so Citibank gives them here's $1,000 worth of U.S. government bonds. Here's my security. So the Fed says, okay, fine, you gave me $1,000 worth of government bonds, but there could be some fluctuations in the market price of the security. So I'm not going to lend you. So the starting value of the collateral is $1,000. So we first need to understand this term called starting value of collateral. The starting value of collateral is $1,000 because the amount that they have deposited, they're depositing three notes worth of current market value of $1,000. So this is the starting value of collateral. Now, the New York Fed will say that fine, $1,000 of worth of T notes, but they could fluctuate in price. So against this collateral, I can't lend you the full $1,000. Just like when you buy a house, the bank will assess the value of the house. So if your house is worth, let's say, 5 million, they're not going to give you a 5 million loan. Okay, so they'll give you like something less. So even if you're not putting up you will have to put up equity for the rest. The bank, if your house is worth 5 million, the bank might give you a loan for 4.5 million. So that half a million that they keep in hand as such is basically that haircut that they're applying. That is the bank's protection against fluctuations in the value of the collateral, right? So the haircut is basically the discount. So the Fed will say, I'm going to apply a 2% haircut. So I'm not going to lend you $1,000. I will lend you what? I'll lend you 98% of the value of the collateral. That's why the formula for this is collateral value times 1 minus haircut percentage. That gives you 98%. Is everyone following so far? Yes. Let me ask
Yes,
some
sir.
first. Okay, good. Yeah, I need to get some sound back because otherwise I don't even know if I'm audible or not. Okay, so this is the situation now. So you've got a few terms: starting value of collateral, you've got haircut, and then you have the loan amount. Okay, so the loan amount is basically, and that's pretty easy to figure out once you've got the starting value of collateral and the haircut. Okay, so the loan amount is equal to dollar 980. Okay, so this is basically the percentage. So if you want to define haircut, it's the percentage discount applied uh, to the discount applied to the starting value of the collateral by the lender to determine the loan amount, basically. So you understand the amount that he's willing to lend. So the loan amount will only be the one that he's willing to lend. Okay, so starting value of collateral haircut is percentage discount applied to the starting value of the collateral by the lender to determine the loan amount. Another thing we can say, what is the purpose of the haircut? Um, Haircuts are applied to protect lenders against uh, adverse fluctuations. It's not writing a big word like adverse fluctuations. Actually, because if the price of the uh, house that you borrow against for your housing loan, if the house price goes up, then there's no problem. If it goes down, then there's a problem. So we just write a simple thing. We can say declines in the value of collateral. Actually, it should be the collateral. Declines in the value of the collateral. Okay. So because this is what they are holding on, this is what they have to fall back on, because I mean, in case there is a default in the loan, they have to, they will seize the collateral and try to sell it off in the market. and recover the value of the loan. So therefore, the current market value of the collateral is obviously a relevant matter. It's a relevant matter for the lender to worry about. So if you take a loan with a starting value of collateral of 1,000, and then the house prices start falling, and then within like you have taken a 30-year loan, and within like 1 year, the house is already worth now like maybe $600. So in this case, if you default, the bank is going to be in trouble because they have lent you like $980, and the value of the collateral is only 600. So they'll be out by that much. So that's why the lender is always concerned about declines in the value of the collateral. That is what the haircut is meant to protect against. That's the purpose of the haircut. The actual calculation of the haircut is, you can see what it is. Right. So I'm not writing down the formula because you can see it in the spreadsheet. Okay, so you have loan amount, you have starting value of collateral, you have haircut, then you have a loan amount, right? Now, once again, we're coming back to the repo structure. The near leg, this is what happens in the near leg, okay? And let's call this day one. Okay. And then we have, maybe we can make this a little smaller to fit everything in. Okay. So day one. And now let's just have this as day 14. On day 14, what will happen? The UST notes will now $1,000 worth of UST notes will here. $1,000 worth of UST notes will come to Citibank. Okay, so this will come back to Citibank. So we can draw the arrow here, maybe. Maybe we can draw this. Okay, it's part of the. Yeah, okay, you get the picture, right? So it is $1,000 USD notes, and it's coming back to Citibank. Okay? And what is Citibank giving back to the New York Fed? We have to see. We can just take this. They have to pay a certain amount of interest. They'll have to pay. So another thing that is determined at the time of the repo is also the repurchase price. Okay. So here you can have we can call this the sale, the near leg, which is like a sale, and maybe we need another column here, and make this smaller. We can make this smaller. Okay. So here you have actually a, or is another way to do it, which is we just make this. We don't have to write this here like this. We can cut down a few arrows. Okay. So this becomes put this way. The near leg is basically the sale, okay, and this is the. It should not be here. Let's put it this way. The near leg is the sale, and this is the repurchase. That's why actually I wanted to call it a sale and repurchase agreement to understand it better. But of course, in the market, you must always call it a repurchase agreement only. Okay, so the sale and the near leg are the same color. Okay, so you can put this as green. Okay, and then in the repurchase, we'll see the repurchase is actually the far leg, which is far leg. And in the far leg, you can see two things are happening. Okay, we can put this. The far leg, two things are happening, which is basically how much money should Citibank now pay? Is it okay to pay 980? Yeah. No? Anybody has the ideas? So what you have to determine, another thing you have to determine is the repo interest rate. All right. So interest rate, we can put it in percentage. Okay. So let's say the Fed decided that they're lending money at maybe uh, 0.5%. Or let's say, let's take a big example because we are not connected to the actual level of Fed funds at this point. So let's call this repo rate, let's say 1%. Okay. Right. So the other thing that is determined is that the repo interest rate has to be determined in advance. Okay, so the rate is 1%. So what should Citibank pay here? The amount that because now this you understand what is happening. The bond leg will cancel out. Show this as a repurchase, and then we'll make this a little bigger. Okay, and this will be, let's make it like blue. Okay. So now what should be the here? This is going to the New York Fed. Okay, this is going to the New York Fed, and you can make this a little smaller so everything fits in one view. Okay, so this is going to the now you see the bond leg is going to cancel out. Can you see that? The bond leg is canceling out because $1,000 T notes going. Is the arrow, are the arrows clear? Are they making sense? Are you following what is going on in the arrows? Because obviously this is not a pretty
Yes.
drawing. Yeah, it's not a pretty drawing, but I think it hopefully gets the job done. These arrows mean the T notes are being deposited with the New York Fed. And the New York Fed is giving cash to dollars. This is on the dollar column. Okay. So all this here is dollars. Okay, except for obviously the percentage. Now they are sending $980 to Citibank because the haircut is 2%. These are all arbitrary numbers, of course. And the repo interest rate also has to be determined. So what does Citibank have to now? So the bond leg will cancel out. You can see that. The bond transactions will cancel out because $1,000 T notes in and $1,000 T notes out. So it's cancelled. The bond leg is cancelled. So now you can see why it's called a secured lending and borrowing transaction, because all that is happening is actually the New York Fed is lending money to Citibank for 14 days and then they'll take money back. So my question is, how much should they have to pay? Let's see how much time we have left. We're already at 12:15. No, that's the alarm actually. Okay, we have a little bit of time. We'll just make sure that we have to finish this job today at least, this month, and the entire connection to open market operations. So anyway, let me not then ask questions because that'll slow us down. So here what they have to pay is, you look at the interest rate. Remember that this is this is a borrowing transaction. You guys borrowed money. So the lender is not going to accept 980 here back. Because 980 is just, when you borrow money, you have to pay P plus I. 980 is just P. So you can't just pay P back. You have to pay I as well. And they have fixed the interest rate, right? We have to write one more thing, that every repo has two legs, there are a tenor associated with it, and a repo. We can just copy from here. Repo interest rate percentage. Repo interest rate percentage that is agreed beforehand. Because obviously, when you're doing any kind of borrowing between, I'm not going to write perfect English, lender and borrower, with the lender and the borrower, we just write lender and borrower. Okay. So, but there's also an interest rate that is agreed beforehand between lender and borrower. Okay. That obviously, because in any borrowing transaction, you've got to have an interest rate that is agreed first between the lender and borrower. So, okay. So, so this is another thing that you have to note. So, what these guys have to pay here is, you have to figure out, okay, that here. So we'll just use 365 days. So you have to pay interest on what you borrowed. Okay. So what is the principal? The principal is 980. Okay, so you pay. Let's split it up into terms so people understand. If you pay 980, if you pay 1% on 980, okay, that is interest for 1 year, because interest rates are always quoted on per annum basis. So you borrowed 1% for 1 year, If you borrow 1% per 1 year with a principal of 980, your interest bill is this much. Okay, but of course, this is not the full amount. Okay, so you have to then multiply this. I'm just doing the formula, then you'll understand it. So basically, what you have to do is then, so interest for 1 year on 980 is 980 into 0.01. Interest, that is interest for 365 days. So interest for 1 day is divided by 365, and interest for 14 days is multiplied by 14, right? So therefore, you have to do multiply by what? What should I write here now? Can you please tell me? Can tell? Are you guys following what I'm saying? Now you should be able to tell me how to write the formula. I don't know how to write the formula. What should I write? You followed what has to be done? 1 minute. Okay, so let's just write it here. Okay, so it has to be 14 by 365. Actually, US money markets work on a 360-day year, but we'll not complicate the matter. Those are just conventions. You can learn that later. But we'll just, for the sake of simplicity and understanding, we'll write this 14 into 365. Yeah, so this is obviously just the interest. Okay, this is just the interest, because then you have to write the interest. I'm writing everything in brackets so that everything is clear. Right now, you can see that hopefully this answer is correct. We have made many mistakes. Let's see. Okay, so if you see 1% into 980, that's your interest. Okay, 9.8. So there's some okay, 9.8. If you divide that by 365, you should get, okay, this is by 365. Okay, this, and you should take this into 14.375. Okay, so 980 and 375, whatever. Okay, 0.37. So this is what you have to pay back, which is basically you have to pay back P plus I. Okay, so you can call this P plus I. Plus I'm writing I with a small I so that it looks more like interest rate. Okay, so are you guys following what is happening here? This is the repayment of principal. In the far leg, you repurchase. So another thing that happens is, so now you see all the properties of a repo are coming out. Okay, this will be, we can make this, it's looking very big actually. We don't need to have it so big. Okay, so every interest rate, then the price for the collateral. Okay, I'm not writing bonds, but it's actually bonds itself. The price for the collateral on the far leg. If I can save my writing, the price for the collateral on the near leg will be lower than which is basically a way of saying that the price for the collateral will be higher on the far leg. I just wanted to save my time writing, so I wrote this way. So this is basically, this reflects the payment of interest. Okay, because remember, it's a lending transaction. Payment of interest on the loan. This represents the payment of interest on the loan. All right. So now this just reflects the payment of interest on the loan. Let's see how much we have. Very few little minutes left. But now you see the full connection to open market operations. Now you already understood it. Okay. So I gave you the example of the New York Fed because you need to understand US financial markets. But the situation with the RBI in India is exactly the same, right? So until recently, RBI used to have, until a few years ago, they used to use actually the wrong terminology, not the international convention. But now they have switched, I think about 10 years ago or something, they switched. So they're now using the international convention. That's why in India, we call it the repo rate. Actually, the repo is only for the commercial banks. Okay? So when the RBI says repo, they're talking exactly like the New York Fed. So now you can see the connection to monetary policy, where this is the connection to monetary policy. The central bank will have a target rate for the repo rate. In India, we don't have, we have a target rate for inflation, but the repo rate they basically set, right? Now here, these guys have a target range, and then they're putting a target range. They're watching it. The New York Fed is watching it. If it goes above, if money is too tight, they'll pump money into the system and bring excess supply of money will bring the interest rates down. It will come back into the target range. On the reverse side, if the money is tight, they will do reverse repos. Again, they're talking from the point of view of the banks. If you see the language here, I'll try to increase a little bit so that you understand. Okay. In a repo transaction, the desk purchases securities from a counterparty. Okay. Actually, this is a repo transaction for Citibank, not for the desk. Actually, it's for the New York Fed is a reverse, but this is how they talk. Okay. So the desk purchases securities from a counterparty. Okay. What is happening? They're purchasing securities from a counterparty, right? And they're paying the purchase price, which is actually the loan amount, right? The loan amount, and then on the reverse leg, on the far leg, they are going to just reverse that transaction and force the dealer to repurchase the securities. Okay, so this guy will technically call it a reverse repo, but in the way, from his guy's perspective, they actually talk from the point of view of these guys. Okay, that's what you'll see on the website on the web page, right? So this is another term that we can use. This is the loan amount. You've already seen, of course. Okay, loan amount. So this is how. So now coming back to the question, just have one point, just half a few minutes left. Okay, in an outright, let me just put this. So when I asked Soumya about when they do, so the answer to Soumya's question, what I asked Soumya was that do they buy bonds outright? In the case of quantitative in QE, okay, bonds are bought outright, okay, with no repurchase. Bonds are bought. I'll just finish this in 2 minutes. Are bought outright with no repurchase or resale date in mind. Okay, bonds are bought outright. Outright means that there is no. I'll just take 2 minutes to explain this outright business. Okay, there's a difference between an outright purchase of bonds and a repo purchase of, because the reason I asked Soumya that question is because you see here also in a repo transaction, the Fed is buying bonds. Okay, in a reverse repo, the Fed would be selling bonds. So, but these are actually not outright sales because they are part of a repo transaction. So this does not create a net position in bonds. You understand what I mean by net position? If I buy 10 kilos worth of sugar from one party and sell 10 kilos out of sugar to another party, I don't have a position in sugar because my position is square. I have two gross purchase or two gross transactions. One is a purchase, one is a sale, but net is zero. My position is zero. The basic point about outright transaction, in QE, bonds are bought outright with no fixed, no date fixed. Bonds are bought outright, no date fixed for reselling them. Okay. Okay. This is basically for reselling them. Okay. Spelling. Okay. There's no date fixed. So in the case of outright transactions, there is only one leg, and in repo transactions there are two legs. In outright transactions, so when you say outright purchase of bonds, then that means you just bought bonds and there's no like two legs to it. There's just one leg. Okay. So in outright transactions, there is only one leg. Okay. In repos, In purchases that are obviously that I'm just saying that I'm just writing in repos. There are two legs, obviously, as you know. Okay. So actually, what I should be writing here is that in purchases of bonds, if bonds are bought, okay, if bonds are bought as part of repos, okay, if bonds are bought as part of repos, then if bonds are bought as part of repos, if bonds are bought as part of repos, uh, okay, there would be two legs. Okay, and which means the fundamental difference between the outright purchase and the repo is a repo, any purchase that is happening as part of a repo. Okay, from this guy's side, it's a sale. From this guy's side, it's a purchase. Any purchase that is happening as part of a repo is there's going to be a back. It's going to be reversed by another leg at the far end. So there are two legs, and this does not create a net position in bonds. You see, the net bond position is zero. The net position after this is the FRB the New York Fed has some interest income, and these guys have an interest expense. That's the only net position. So the debit for them, credit for them, interest income. That's it. And these guys borrowed money, but there is no net position in bonds. If you do outright purchases, there is no second leg business. Okay, there is no, and so when you do a repo bond purchases as part of repos, there is a definite date which is fixed for reversing that transaction. Are you following? Okay, everyone followed this transaction. Okay, so I'll let you guys go, and that so the class is dismissed as such, and we need to just check if is there anybody else who 1 sec. Let me is there anybody else who wants to take who was here who was not present at the beginning, or should we close the attendance? Any such person? No.
Sir Kirit.
Okay, 1 minute. Kirit. Okay. Anybody else? No? Okay, we have a lot of absent.
Sir
people.
Isha.
Isha is here. Okay, good. Okay, good. Anybody else? No? Okay, so we are watching that one quickly. Vartika is absent. Sanchit is absent. Ruchi is absent. Rohit, Ritvik, Pranav, Neha, Naman, Muskan. No, Muskan is present. Neha, Naman, Monica, and Mansi. Okay, and Jasleen, Chetan, Bhavya, Ayush, and Aditya. Okay, so we submitted. No more markings required. We submitted. Let's see, they accepted. Okay, we accepted. Okay, now I just have one more 23rd September, which Parth will remind me. If it's not by tonight, Parth will send me a reminder mail. So by tonight it should be, or latest by tomorrow after I get his mail. I'll do it tonight itself. Okay, so that'll get taken care of. Okay, so what I'll do now, the class is dismissed. You guys can leave. Okay, so this is my last. Yeah. So since this is my last class, I'll just put down my email here later on. You can write me. You can write to me at that point. You can write to me on the email. Okay, if you want to contact me on my private email, I'll just write it later on in the sheet. Okay, so the class is dismissed. You guys can leave, and anybody who has a question can stay back.
Sir, I just want to ask one thing, sir, regarding papers. So, you will be giving the theory questions or case-based questions?
No, it will be theory in the sense like actually this distinction is not correct actually. So everything in life is theory. Okay, without theory, you don't know. The question is what kind of theory.
I'm just
Okay.
linking to
Yeah,
case or something.
yeah. So
like that.
no, there may not be a case or anything, but it's all conceptual. Okay, so basically, if you have understood the concepts that we have discussed, and some of the questions may relate to some kind of institutional arrangements and all that. So basically, if you paid attention and whatever we have discussed in the notes, only that is going to be asked. Okay, and maybe sometimes I'll have one googly or something for a small marks, so a little few marks just to see. But otherwise, most of you, if you have generally studied whatever I've taught you, okay, the advantage here in India is that we, especially in our kind of institution, is that we, whatever I teach you is the syllabus. So we have the right to define the syllabus. So we are not bound by like a university system where we have a fixed syllabus which has to be
Yes, sir.
covered. Yeah. So whatever I've taught you is the syllabus, and then if you master all the concepts which are there in the notes, you have paid attention, then you should be fine, absolutely, no problem. But you should not think of this as theory and numerical. This distinction is actually not correct, because even if you're assembling a desktop computer, it's all theory, because you have to know what kind of motherboard goes with what kind of processor, goes with what kind of RAM. This is all theory. It's only when
Yes.
you're instructing your assistant to tighten the screw a little bit. That's a motor skill. So there's no real theory in that, because there's nothing to think about. You're telling him what to do. But everything else is theory. So it's only a question of what kind of theory, right? So that's the question. So I've tried to teach you theory, which is going to help you in the, well, of course, this time we were following the book, but again, I was trying to depart from the book and teach you things which are directly relevant, which are going to be more relevant in the real world. Yeah. So that's it.
Okay, that's it, sir. Thank you so much, sir.
No worries, no problem. Okay. All right. So good luck for your exams. Okay. Anybody have any other question? Okay, so Soumya, is that still there? Soumya, you understood why I asked you the question of are they buying bonds as part of repos, or are they buying bonds outright, right? So because you can have purchase of bonds in two types of situations. Okay, all right. Then if there are no other questions, then I will stop sharing the screen, and I will end the presentation. Okay, okay. Take care. Bye. So I'll stop. Also, first I have to stop recording.